Good morning, and thank you for joining us today for our One Big Beautiful Bill and What It Means to You webinar. I'm Anthony Cinto, Chair of MMB+CO's Tax Department. I'm pleased to be joined by two tremendous tax professionals from MMB+CO today. In addition, I want to also thank all of those that have made today possible, including our marketing department and others who contributed to the content of today's program. Christina Stamatis will be covering the individual taxpayer provisions, and Steve Wiest and I will be covering the business taxpayer provisions. Our goal today is to provide you some initial planning ideas for key provisions of the new law. As with all new law, further guidance is expected from IRS and Treasury. We intend to provide additional guidance through both our newsletter and future webinars in the weeks and months to come. Before we get started, there are a few housekeeping items that I'd like to cover. While we don't anticipate any problems, technology can be unpredictable. Our goal is to keep everything running smoothly. This session is being recorded, so if you experience any technical difficulties, you will be able to access the full recording by the end of the day. We want this session to be as interactive as possible. Feel free to submit your questions at any time using the question function in the top right corner of your screen. We'll address as many of these during the session as we can, and if we don't get to your question, we'll follow up afterwards on any that we don't get to. A copy of the presentation is available for download during the session under the Materials section of your dashboard. If you're unable to download it, don't worry. A follow-up email will include contact information so that you can request the materials directly. We truly value your feedback. A brief evaluation survey will be available at the end of today's session and included in the follow-up email. Your input helps us improve our programming and plan future content. If you're eligible for CPE, please ensure to answer all 3 polling questions during the presentation and submit your completed evaluation to the email provided. Certificates will be issued upon receipt. In addition to this webinar, we cover a wide range of industry-related topics in our electronic newsletter, the MMB Messenger. Since you registered electronically for this session, you're also subscribed to receive the newsletter. If you haven't been receiving it, please contact Jenna Laurie to confirm or update your email address. Let's move into the agenda to see what we're talking about today. We've covered our housekeeping and our introductions. As I mentioned, we're going to first move into individual tax planning and wealth strategies. And then we're going to cover that up with business tax strategies and incentives, and we'll do a little wrap up at the end. At this stage, I'd like to turn it over to Christina Stamatis, who will cover our individual tax planning and wealth strategies. Thank you, Christina.
Good morning, everyone. Thank you, Anthony. I am going to get started here on our individual provisions in the One Big Beautiful Bill. There are several provisions that were enacted in 2017 as part of the Tax Cuts and Jobs Act, which were scheduled to expire at the end of 2025. The One Big Beautiful Bill has made many of those permanent. There are far too many individual provisions in the bill to cover in our time today, so I'm just going to highlight the most relevant and broad-reaching provisions. We have our lower individual tax rates that have been made permanent. So we are not reverting back to those higher rates with the 10 and 12% indexed for inflation. The increased standard deduction amounts have been made permanent. The new amounts are on the slide right there. You'll see we have $31,500 for married filing jointly. Those are also adjusted for inflation. The personal exemptions have been permanently repealed, as have the miscellaneous itemized deductions. The child tax credit has been made permanent and increased to $2,200 for every child under age 17, of course, subject to income phase outs. The charitable deduction for non-itemizers that was available during COVID has been made permanent and increased to $1,000 for single taxpayers and $2,000 for those married filing jointly. So all on this slide have been made permanent. We have some new temporary provisions. These are all effective 2025 through 2018 on this slide. And we're going to see a lot of guidance coming from the IRS on these provisions to prevent abuse. So first, we have the $6,000 senior deduction. This was intended to be the no tax on Social Security that didn't quite make its way through the bill, but this achieves a similar result. So it's $6,000 per qualified individual. Qualified individual has to be 65 by the end of the taxable year, and you don't need to be collecting Social Security income in order to take advantage of this deduction. And you'll see the phase outs, the income phase outs levels are in the third pane of this chart here. We have no tax on tips and no tax on overtime. So there's a deduction of up to $25,000 on tip income and a deduction of $12,500 of overtime income available. The tips must be voluntary tips in occupations that traditionally receive tips. And the employer needs to report those tips on a W-2, or the employee can self-report on a specific form. And the overtime is the standard time and a half overtime is prescribed by the FLSA. So it doesn't go towards, working holiday time or Sunday time in different industries. It's a strict, FLSA overtime. Both the deduction for overtime and tips are reduced by $100 for every $1,000 that income exceeds the threshold. We have a new deduction for auto loan interest of up to $10,000. This is not available for leased or used vehicles. It must be a new vehicle. It has to be a passenger vehicle less than 14,000 pounds. And it is also applicable to original owner refinanced loans. Most importantly, final assembly of the vehicle must occur in the United States. And this deduction is reduced $200 for every $1,000 that income exceeds the threshold, which is a fairly low threshold. So this deduction can get phased out to zero fairly quickly with a married filing joint couple earning $250,000. So all of the deductions listed on this slide are available to non-itemizers, which is important to note. Finally, for a temporary provision, we have a tax-preferred account for minors. All U.S. babies born through 2028 will receive $1,000 from the federal government. There are a lot of rules around these accounts, and I expect much more guidance to be issued. First, the funds need to be invested in a qualified index, which is a fund comprised mainly of U.S. companies. The child will not have any access to the funds until they reach age 18, and then 50% of it can be used for qualified purposes. Well, what are qualified purposes? Higher education, small business loans, a home purchase, and those disbursements are taxed at capital gains rates. At age 25, you can take 100% of the funds and use those for a qualified purpose. And at age 30, the funds can be used for any purpose. Important to note that any purpose other than a qualified purpose is taxed as ordinary income. There's currently no way to put this into a retirement plan, such as rolling it over into a Roth IRA, but that may change. Family members can contribute to this fund up to $5,000 annually. Important to note, there is no deduction for these contributions. If the family member's intent in making contributions is to save for education, the better way to go is investing in the 529 plans that we have through New York State, because those funds will come out dispersed fully tax-free, and you get a deduction on your New York State tax return. But still, there's different uses for this fund, and I expect more guidance to come out on that. Next, we have what I consider to be the star of the bill, at least on the individual side of things, and that is the increased SALT deduction. The deduction for state and local taxes has been temporarily increased through 2029 from $10,000 to $40,000. It does start to phase out when income exceeds $500,000, but will not go below the $10,000 floor. If you are in a partnership or an S corporation and have been participating in the PTET or the pass-through entity tax, that was our sort of workaround to the SALT limitation. You might want to revisit participation in the PTET to see if it still makes sense for your individual situation, because these two provisions can work together. So you definitely want to reach out to your advisor and take a look at that. So why does the increase in the SALT cap matter? Well, New York State residents will especially benefit from the increased cap, as we live in a high income tax and high property tax state. So what does this mean? We are back to the days of itemizing. Most of you have probably taken the standard deduction since the Tax Cuts and Jobs Act was enacted in 2017, because itemizing with a tax limitation of $10,000 became difficult. So you probably have stopped tracking your medical expenses and your charitable contributions. Well, you're going to want to start to track those again. So what can we do to maximize our deductions? So if you're paying estimated taxes, you're going to want to pay your fourth quarter estimate, your state estimate, in December rather than January to get the deduction in the current year. Similarly, you want to pay property taxes that are generally due in January in December to accelerate that deduction. And you may want to bunch your charitable contributions in order to maximize your itemized deductions. All of these things will help to maximize your itemized deductions. So this is a big win for New York State residents. All right, on to estate tax. The estate lifetime exclusion has been made permanent and increased to $15 million. This was scheduled to revert back to $7 million after 2025. We still have our annual gift tax exclusion that remains at $19,000 and doesn't eat into your lifetime exemption. Portability is still available, which is if one spouse dies, that exemption follows the surviving spouse, of course, if the proper election is made. And the top federal estate tax remains at 40%. So why does this estate exclusion matter now? Well, you always want to look at your estate today. I mean, even young individuals, you want to get involved today to minimize any potential tax liability down the road. For example, you may want to gift assets that are not worth a lot today, but are expected to appreciate significantly, so you can get that appreciation to take place outside of the estate. It is important to note that the New York estate law did not change. That remains unchanged. The New York State exclusion is approximately $7 million, and that is subject to a cliff where the entire estate can become taxable, not just the amount by which it exceeds the exclusion. Okay, and the last provision I'm going to touch on is QBI, which is the Qualified Business Income Deduction. QBI was enacted in 2017 as a way to sort of level the playing field between the tax rates of C corporations and those of individuals who are invested in pass-through entities. And it allows for a 20% deduction on qualified pass-through business income at the individual level. QBI has been made permanent at 20%, so it's a 20% deduction with some modifications to the phase-in limitations for both specific service trader businesses and other businesses that are subject to the wage and asset-based limitation in a favorable way. Those phase-in thresholds have been expanded to allow for more people to take advantage of the deduction. Additionally, a new minimum deduction has been introduced, allowing for a minimum deduction of $400 for those with at least $1,000 of qualified business income. And those are both indexed for inflation. So what should you do? So there's not really a change in the QBI except for the phase-in limitation. So continue to evaluate whether your income qualifies for QBI, especially with those expanded phase-in amounts. also, take a step back and look at your overall tax picture and see what kind of adjustments can be made to your income structure to maximize the QBI deductions. We do this quite often for our clients. They'll reach out to us and, am I maximizing my deductions? And we'll do projections with different scenarios and different income structures and entity structures. So you always want to continue to do that. And with that, we are at any questions. So hopefully there's some questions in the chat. I think Anthony's going to set me up with those.
Yeah, Christina, thank you. That was great. I would agree. I think that SALT cap is really the star of the one big beautiful bill. There was a lot of discussion about it, and I think everybody was pretty pleased to see that come through, along with the continuation of the qualified business income deduction for any of our taxpayers and clients who are business owners.
Mm-hmm.
So yeah, we do have a couple questions that I think would be worth covering.
Okay.
You talked a little bit about revisiting the participation in a pass-through entity tax now that the SALT cap was increased. And I guess the question here is, what would be the downside of continuing to participate in PTAT?
Well, so if the combination of your state income taxes and your property taxes exceed the deduction that you're getting from your PTAT, you might want to revisit participating. You might not want to participate in order to maximize those itemized deductions. Of course, there are other things to consider too. I mean, how does the PTAT impact the QBI deduction? So this is a situation where you should definitely reach out to your tax advisor and have some projections run, to see which path is the way to go.
Great. We have a couple questions here on no tax on overtime, and I think it's a relevant question. I do think there's probably, and you could correct me if I'm wrong here, Christina, but I think there's probably a lot of guidance still to come on this. But the main question is, if you're looking at the tax on overtime, what portion of pay is the exempt portion?
Oh, that is just the half and the time and a half. Your base pay is not going to be subject to that deduction. It's just the half time and the time and the half.
Got it.
Does that make sense?
Yes. Yeah. So right. So only the incremental piece, not all of it. It's not like we're pulling all of the pay into the exemption.
That's correct.
Okay, great. Another question here. How does the $6,000 senior deductions phase out interact with other retirement income sources?
So for those individuals that are taking their required minimum distributions, which now is required at age 73, that $6,000 deduction could phase out pretty quickly if your RMDs are high. So the sweet spot for this deduction is really for those individuals between ages 65 and 73 who have retired and aren't required to take those RMDs yet if they're subject to higher RMDs. Another thing to consider to reduce your retirement income, maybe to maximize the $6,000 deduction, is to make qualified charitable distributions directly from your retirement if you're going to do some charitable giving, because that will reduce that income and stop the phase out of the $6,000 deduction.
Perfect. That's great advice. One question that I saw come through relates to PTAT. And the question is, if I've already elected PTAT for 2025, but I do some planning and I realize maybe it's not more beneficial than just using the itemized state and local deduction now that it's been increased, do I have anything I can do? Is there anything open to me to get rid of the election?
No, that's a really good question. Unfortunately not. New York State has been pretty rigid with their PTAT elections. If you make the election, you're in. If you don't, you're out. But it's just for 2025, so there might be ways where you could shift income into future years. I mean, definitely there's other options to consider to look at the whole entire tax picture that could help you kind of minimize the PTAT this year and maximize your itemized. So, but yeah, no way to elect out for 25 if you've already elected in. Yeah.
And worth saying, I think, Christina, I mean, I'm guessing the majority of our attendees today are New York State residents, but, I think it's worth also mentioning that many states have created a PTET regime. And
Hmm.
so if you are not looking at New York State PTET, which is really what I think you were speaking to, have a look at your specific state's PTET rules. There may be differences state by state.
Yeah, absolutely. Good point.
Great. Um, I think we've got time for one more, and then we'll move on to business.
Okay.
So the last question I have is related to charitable contributions. So
Hmm.
in your presentation, you mentioned that non-itemizers could have a cash-only charitable contribution.
Hmm.
Are there still the availability to take non-cash contributions as an
Yeah.
itemized?
Yep, absolutely. Those are still available. They're just not for that non-itemized charitable piece. You have to itemize in order to take the non-cash contribution deduction.
Awesome, thank you.
You're welcome.
Great. For time purposes, we're going to move on to the next section, but for all those who put questions in the question box, thank you very much. We really appreciate that. And again, we will track that and somebody will be in touch to answer your questions. So at this point, I will turn it over to Steve Wiest to cover the first half of the business tax provisions and incentives.
Hey everybody, thanks for joining us today. As Anthony mentioned, we'll be starting with the business tax provisions. There's a lot going on here. A lot of them are just extensions of prior provisions or extensions and making things permanent. When I say making permanent, I generally mean that they just are not set to expire at any point. There's no guarantee that they'll go on forever, but pending some affirmative action by future legislation, these things are going to stick around. So we've listed out some key items here. I won't spend much time on this slide just because Anthony and I will be going on them in more detail, but you can reference this later on if need be. So the first thing I'll be talking about is bonus depreciation. So there is bonus depreciation has been around for a couple decades now, and it has been around in some form. The percentage has changed quite a bit. Sometimes it's been 100%, sometimes it's been significantly less than that. But as of the most recent law, the TCJA, it was 100% in 2022 and phasing down 20% for every year after that, slated to phase out entirely and go away in 2027. For those who might not be familiar, bonus depreciation allows you to take an additional deduction above what the normal depreciation allowance would be. So if it's 100%, you could write off 100% of fixed asset values that were placed into service in a certain year without having to go through the depreciation table and spread them out over a number of years. With the new legislation, it was made permanent and changed back to 100%. So pending any further legislation, it's going to stay at 100% for the foreseeable future. There was some legislation kicking around for the last couple of years to potentially restore it, but it didn't actually happen until earlier this year. So you'll note on the chart here that the 100% doesn't actually kick in until January 20th, 2025. It's not a clean calendar year break. So it is important to pay attention to when an asset was placed in service during the year, because that will depend on whether it will be eligible for 40% bonus depreciation or 100% bonus depreciation. One thing that is new in this legislation is there is a new class of assets that's eligible for 100% bonus depreciation, and that is qualified production property used in non-residential real estate tied to manufacturing, refining, or production. So a lot of words there, but if you do have property that fits into that category, it is eligible for 100% bonus depreciation. Bear in mind that there are certain types or areas of this property that are carved out as not eligible. It really needs to be the area that is for manufacturing, refining, production, where that actually happens. So we've listed out some areas that are excluded, which are office spaces, parking, sales, engineering, areas where research is done. So if you have a property that fits this category, it's going to be really important to analyze what areas and what portion of the cost of the property actually qualify for 100% bonus depreciation and which ones are excluded. I think this is going to be an area that is under some focus by the IRS just because the rules are a little bit difficult to understand if you're just first getting into it because it is new and because the impact is going to be so big because the depreciation for buildings and what a lot of this property could be is 39 years versus being eligible to write it off 100% in year one. So big swings in deductions on for this type of property and how it is allocated. So if you do have it, make sure you document, make sure you analyze, make sure you're very comfortable with the amount of property and the value of the property that you are allocating as eligible for this new 100% bonus depreciation. So a couple thoughts on this. It is a big deal for a lot of businesses. I think this is the area in the business tax provision that's going to impact the most businesses, just because pretty much everybody has an investment in fixed assets in one way or another. There are going to be certain industries that are impacted more than other. Real estate is going to be huge for manufacturing. It's going to be big. But really any business that has any sort of significant investment in fixed assets will really accelerate some deductions, and which could lead to lower taxes, increased cash flow, and ability to reinvest in the business or take some cash out. And the one new thing to pay attention to, again, is that manufacturing new class of assets that's eligible for 100% bonus. Moving on, the next thing that I think is going to be a big deal for a lot of people is research and experimentation costs. And previously under the TCJA, this was these costs needed to be amortized. So the amortizable life depended on whether they're foreign or domestic costs. If they're domestic costs, the amortizable life was 5 years. Foreign costs were over 15 years. But the new law changes that. And after 12/31/24, you are able to, or I should say, for tax years beginning after 12/31/24, small distinction there. For those years, you are able to go back to fully expensing domestic costs. So foreign costs, no change there, still have to amortize them over 15 years, but domestic research costs, you are able to expense them like you were prior to the TCJA. Also, this provides some relief for some prior costs for 22, 23, and 24. If you're a small taxpayer, which means that you have gross receipts of $31 million or less, you are able to amend your prior year returns to retroactively claim those deductions. So it's as if you never had to amortize them in the first place. You're able to go back, amend, claim those deductions. But even if you're not a small taxpayer, you are able to accelerate the deductions in 2025 or over 25 and 26. So you can do that if you're a large taxpayer or if you're a small taxpayer and you just don't want to amend prior year returns. So there's a chart here that summarizes the changes. One thing to note is in that first row, that you still are able to amortize domestic costs if you want to. I think in most cases, it's going to be beneficial to just expense them right away, but there could be certain situations where amortizing the cost makes sense. So usually the way that tax legislation works is that it is passed by Congress and the president, and then the IRS comes in after to interpret the new laws and provide some guidance on how the reporting will be. And normally that's fine. I mean, for an example like bonus depreciation, we know how that works. You just take the right amount of deduction. But for the research and experimentation changes, it's a little bit more interesting because we just don't know how to implement those changes. So is it going to be an accounting method change? We need to file 3115 to do that. Do we need to do a statement on the tax return? Do you just take the right amount of expenses under the new law? And this is especially important for a couple of reasons, because there are small taxpayers who are interested in going back and amending prior returns, but don't really have the information to be able to do that and feel confident about the reporting methodology. So we kind of know what the right answer should be, but how do we actually report that on the tax return? And secondly, if you have somebody who is extending their 2024 return, hasn't filed yet, and they still need to file it, and they know that the 2024 expenses are going to be deductible, how exactly do you do that? So still waiting to hear some guidance on that. Hopefully we will get something soon. I mean, the IRS knows that this is kind of a more pressing matter for a lot of people. So hopefully we're going to get something. We'll be able to move forward with that. But right now we're in a little bit of a wait and see situation to be able to move forward, amend returns, claim deductions, and enact the law that was recently passed. So a few planning ideas. There is now more of an incentive to keep R&E costs domestic. Previously, there was an incentive with a 5-year amortization versus the 15-year amortization for foreign, but now there's even more of an incentive just because there is immediate write-off of domestic costs. So if you have foreign costs and you could use the additional deductions, it could make sense to evaluate whether it's feasible to bring those back stateside, or if you have new research and experimentation activities, it makes sense to evaluate whether you can do it stateside and get those additional deductions sooner, or whether foreign makes more sense for your business. But there is now even more of an incentive to keep those costs domestic. And this law is interesting because it provides a lot of different options for how to treat the deduction. So if you're a small business, you're able to go back and amend if you choose to do so, or you can accelerate the costs and the deductions in 2025 or 2025 and 2026, or just amortize them like you used to. And even if you're not a small taxpayer, you can still accelerate the costs, or you can spread it over 2 years, or you can just not do it. So it's kind of nice that there's a lot of flexibility in the treatment of these, able to determine kind of what the right path is for you. And I think the answer is going to be different for a lot of different people. But if you have significant costs and you can use the deductions, it would make a lot of sense to model out a few different scenarios and try to determine what is the best path going forward. And the last thing that I'll be going through before turning it over to Anthony is opportunity zones. This is a program that's been in place for a handful of years now. And the idea is to provide an economic incentive for people to invest in underserved geographic areas that states want to encourage investment in. So they do this through a few different tax incentives. One is if you roll over a gain from a prior investment, you're able to defer that gain, not pick it up in income in the tax return for a number of years. Also, if you hold the opportunity fund investment for a certain amount of time, you're able to exclude some of that gain entirely, as well as have tax-free appreciation on the actual opportunity zone investment. So a few different tax benefits there. And it's been going on for a little bit now. And the new law does make this program permanent, and it does make some tweaks to how it works and what the tax incentives are. One thing that it did not change is it did not extend being able to defer gains past 2026. So if you're somebody who had previously had an investment in one of these opportunity funds, you will have to pick up any deferred gain on your 2026 tax return. So make sure you're planning for that. And it also kind of opens up a new round of this program starting in 2027 that has many of the same tax benefits as the prior program did, but it does have some differences. So one of them is that if you roll over a gain from a prior investment, you still get to defer that for 5 years. So it's a little tax deferral there. And also you can have some permanent tax decreases if you hold the investment for 5 years. So you get a 10% basis step up, which means that essentially you are eliminating 10% of the gain you would have had to So that permanent tax decrease, which is always very nice. This new round of program also introduces a new type of opportunity fund called the Qualified Rural Opportunity Fund, and each state will designate which one of their geographic areas meets the criteria to be a Qualified Rural Opportunity Fund. And that is provides even a bigger benefit where you get a 30% basis step up, exclude 30% of the gain instead of the 10% for a normal non-rural opportunity fund. Also, this continues the prior program of having some tax-free appreciation on the opportunity fund investment itself. If you hold that investment for 10 years, then essentially you're excluding any of the appreciation on that investment from taxable income. Interestingly, with the new law, they did cap that at 30 years, which is kind of an interesting choice because I don't know how many people actually hold these for 30 years, and it's a very long time. But interesting to know that if you do hold it for more than 30 years, then the tax-free appreciation is capped at what the appreciation was for the first 30 years that you held it. There's also some increased reporting requirements and some more oversight. So if you run one of these funds or you're an investor, you'll probably see some of that as well. So what does this mean? There's first thing is that there's no extension for this 2026 deferral if you did invest prior to 2027. So make sure you're planning to pick up that income on your tax return, potentially make some estimated payments, potentially see if you can offset with that with some other tax losses. And for new investments, there is some new deferral opportunities, so 5 years potential deferral, as well as decreasing your overall taxable income by holding the investment for 5 or 10 years. So, I mean, this is a powerful program. I think that if there is an investment in that qualifies as an opportunity zone investment in an opportunity fund, that makes a lot of sense, and you feel good about the investment and kind of compared to other investments you can make, this provides a nice leg up just by giving some additional tax benefits, and it can be a really powerful tool to kind of improve and defer your overall tax liability if you can find an investment that you're happy to roll your gains into. So with that, I'll turn it over to Anthony. He's going to take it over from here and talk about some of the other impactful business tax provisions in the new law.
Thank you very much, Steve. Appreciate it. We're going to move right into a provision that I think will be very beneficial to a lot of clients and a lot of operations, especially those that are either capital intensive or for those companies whose capital structure is very debt heavy. 163J was introduced back in the Tax Cuts and Jobs Act, and this is a deduction limitation on interest expense. Under the Tax Cuts and Jobs Act, the interest deduction was initially calculated using essentially EBITDA, so earnings before interest, taxes, depreciation, and amortization. And that was essentially the calculation from 2018 through 2021. But starting in 2022, the law shifted to essentially base the limitation on EBIT, earnings before interest and taxes. So you didn't get to add back depreciation and amortization. And for a lot of companies, especially those with, again, capital intensive businesses, that made a big difference. And there were significant deductibility limitations for interest expense. Starting in 2025, under the One Big Beautiful Bill Act, we are returning to an EBITDA-based calculation. So that does mean that depreciation, amortization, and depletion are once again included in adjusted taxable income. For those of you who've been feeling the pinch since the switch to EBIT in 2022, this will be a meaningful shift. So let's talk a little bit about how the calculation works, because I've thrown a number of acronyms out there. when I talk about EBIT or EBITDA, I'm really using that as a proxy for adjusted taxable income. And the way that the deductible business interest expense calculation works is that the taxpayer is limited to deducting 30% of adjusted taxable income plus interest income plus floor plan financing interest, the latter being very industry specific. So really, when we talk about EBITDA and EBIT, we're really referring to different definitions of adjusted taxable income, which is the base for our limitation. When we look at adjusted taxable income, the basic formula is business interest taxable income before business interest expense, business interest income, net operating losses, and then if it's 2025 and after now, before depreciation, amortization, and depletion. So under the one big beautiful bill, we once again are able to add back depreciation, amortization, and depletion to taxable income in order to arrive at that adjusted taxable income number. This increases the base on which that 30% limit is applied and should allow for quite a bit of additional deductions in, again, capital intensive businesses. In reality, I think that this will help these capital intensive businesses or debt heavy capital structure businesses really take a bit more cash and invest further. And when you pair this with the accelerated depreciation deduction that Steve had mentioned earlier, you're really in quite a different place than you were as of 2024. So this is a great opportunity to look at your planned capital investments for 2025 and after. You may have already done a lot of planning prior to 2025 and the passing of this bill, but I think it's probably time to go back, take a look at those plans, and revisit whether or not they should change. Also related to 163J is an election out. So for certain real property trade or businesses, there is an election out of 163J. This has been there since 2017. This isn't necessarily changing, but just to highlight this, a little bit of background here is that if you are a qualified real property trade or business, you have the option of electing out of the 163J limitation. Well, what's your trade-off? If you elect out, number one, the election is irrevocable. So once you elect out, that's it. You can't go back. Additionally, you have to use the alternative depreciation system, which generally results in longer recovery periods and disqualifies the assets from bonus depreciation. So essentially the trade-off is you can deduct more interest in exchange for depreciation. So it's ultimately timing because you'll still get your depreciation deductions. It's just that you may not be able to accelerate those depreciation deductions, and you may have to recognize that depreciation over a longer period of time than you otherwise would have. So when we've discussed this part of the provision with clients prior to the One Big Beautiful Bill Act, we've talked about sort of planning. And when we think about it, it's really looking at what is the plan for that particular property or the entity, the properties within the particular tax-paying entity that we're looking at potentially electing the 163J limitation out of. So if you're looking at that business and you've got a whole bunch of renovations and you wanted to accelerate those renovations, maybe it wasn't the best bet to elect out of 163J prior to the One Big Beautiful Bill Act. Maybe it was better to let it ride, take your accelerated depreciation, and once your EBITDA, your ATI kind of levels, you might be able to get more interest deductions in future periods. Versus maybe an entity that has sort of we'll call it a mature business or mature real property business, you may not want to deal with that. You may not have a lot of new additions of depreciable assets that you can accelerate. So opting out of 163J in that kind of a situation may have been better. at the end of the day, I think it's worth having a look at this real property trade or business election in light of the fact that the limitation is more favorable in 2025 and after. So it's an important discussion to have. Think about what your plans are. One word of warning, as I mentioned, this election is irrevocable. So if you've made this election on some of your entities prior to the One Big Beautiful Bill Act, you are in fact tied into that election. So really, the planning that I'm talking about is mostly going to be for entities where that election has not yet been made, where you still have that flexibility. And again, I think what's important here is really thinking about cash flow, really looking at and doing some projections around depreciation of assets. When will assets be placed in service? Thinking about the new 100% bonus depreciation rules, especially the non-residential real estate that Steve mentioned earlier, and then also looking at your capital structure and debt structure to get a sense of what your best options are here. And we're always here to help, and we can help talk about this with you as well. We're going to move into excess business losses. I think it's a provision that sometimes is overlooked, but it can have a really, really big impact. So I think it's important for us to talk a little bit about this provision and what it means and what the changes are from the One Big Beautiful Bill Act. This provision limits the excess business losses for non-corporate taxpayers, and it's now permanent. So the One Big Beautiful Bill Act has made this provision permanent. For 2025, that means that you can deduct up to $313,000 if you're single, or $625,000 if you're married filing jointly. Anything above that becomes a net operating loss and carries forward. So let me take a pause here. We're in the business section, but we're talking about really the impact to individual business owners. This really does kind of have a little bit to do with both the business side of taxation as well as the individual side. I think clearly the large impact is on the individual business owners in this case, but a lot of what you can do to plan and to model and project really is on the business side. And that's why we're talking about it here. So under the Tax Cuts and Jobs Act, let's go back a minute and talk about some of the history. This was introduced as a temporary measure, and it was originally set to expire in 2025. And now, obviously, as permanent, it is locked in for good. So how does the calculation work? Well, you want to start by aggregating all of your income and losses from your trades and businesses. So this is looking at any trades and businesses that you have participation in, income, losses, deductions, gains. Then you subtract any gains from investments that aren't considered business income. So we're trying to really isolate what your net loss is from trade or business income. If your net loss from business activity exceeds the thresholds mentioned above, so again, $313,000 for single, $625,000 for married filing jointly, that's for 2025, the excess is disallowed for the current year and converted into an NOL. So taking a step back, that means that I can use $313,000 if I'm single, or $625,000 if I'm married filing jointly, as a loss from my businesses to offset other income on my personal income tax return. Anything above those amounts gets disallowed for the current year and gets converted into an NOL. So just a quick reminder on NOLs. If an NOL is generated after 2018 or later, it can be carried forward indefinitely. But remember, they're limited to being able to offset 80% of taxable income in the future periods that they're carried forward to. So even if you continue to have losses in future years, it's really going to be problematic because you may continue to have a disallowance and be limited to offsetting 80% of taxable income in those future periods as well. So something to just keep in mind. So the good news is, even if you are limited under the EBL rules, you're not losing that loss. You're just pushing it forward, and it's becoming an NOL that can be carried forward indefinitely. One kind of small nuance here, just to mention, since we're kind of talking about the intersection between the excess business loss limitation and NOLs. If you have both current year business losses and prior year NOL carry forwards, you utilize current year losses first. Then, if you have excess income without being limited, you can use any carry forwards at that point. But again, remember that's subject to that 80% limitation of taxable income. This affects a lot of our clients, and especially those with pass-through entities, real estate investments, or trading activity. It's going to be important for you to look at your business structure and think about the activities that are occurring within your businesses. There may be an opportunity for you to look at particular activities within existing pass-through businesses, isolate those activities, and put them into a different type of tax-paying entity like a C corporation. The C corporation doesn't impact the EBL limitation for you as a business owner because a C corporation doesn't pass its income through to its ownership. And it's also not limited in its ability to use NOLs in the same way that the EBL limitation puts such a burden on individuals. So there's some planning here that must be done. And at the end of the day, with a lot of other accelerating depreciation provisions included in this bill, depreciation on fixed assets at 100% bonus, now being able to fully expense R&E expenses, it's really going to be important to look at how that impacts net operating losses and your ability to utilize those net operating losses with the conjunction of that excess business limitation. So again, bottom line, this is now a permanent rule. So make it part of your long-term strategy. Prior to this one big beautiful bill, we weren't sure whether it would be permanent or not. It was temporary. And so we were doing more short-term planning, but it is permanent now. So take a look at your overall tax planning strategy. It may have an impact on how you structure your business overall. All right, I'm going to move into clean energy. This is the last business section we have. The headline here is that the One Big Beautiful Bill has really reshaped the landscape with energy credits and clean energy incentives. There are several credits that are being phased out. For example, the clean vehicle credit ends after September 30th, 2025. The home energy efficient improvement credits are gone after December 31st, 2025. And really important here, the commercial building deduction under 179D is repealed for projects starting after June 30th, 2026. 179D was huge for a lot of our clients that were real estate investment companies, real estate management companies, and architectural or engineering companies. This is going to be gone after projects that are starting after June 30th of 2026. And this was really impactful for many, many taxpayers that were able to take advantage of it. So I really want to emphasize, now is the time to start looking at where you might be able to take advantage of 179D. And just as a quick refresher, 179D is a deduction for energy efficient improvements made to commercial buildings. So this would include things like interior lighting systems, HVAC and hot water systems, and the building envelope itself. And to qualify, the improvements have to reduce total annual energy and power costs by at least 25% compared to a baseline building that meets specific energy efficient standards. So keep in mind, this is going away. The bottom line here with the energy efficient and clean energy provisions, of which there's many, you'll see in the slides, these grids that have many of these listed along with what they are and what their duration is under the new law. Have a look at them, have a conversation with your tax provider, and try your best to look at timing. I think timing is the key for planning with these clean energy and energy efficient provisions. So that brings us to overall questions and answers for businesses and for individuals. So I'm gonna ask Steve and Christina to join me again. Thank you guys. Welcome back, and thanks again for the contributions in this presentation. It's greatly appreciated. Conscious of time, so again, I want to reiterate to our participants, we probably only have time for 1 or 2 questions, and then we will find a way to get back to everybody after this presentation. Steve, I've got a quick question for you. This is related to R&E. Is it better to amend prior year returns to deduct research expenses or to catch them up in 2025?
Yeah, this is a classic tax it depends answer. It depends on what your prior deductions were that were hung up. It could make sense to go back and amend if it'll result in some refunds and potentially being able to get those refunds sooner instead of having to wait until you file your 2025 tax return and catch up those expenses. But if it doesn't really make much of a difference, it could be administratively easier just to push those through 2025. And something to consider also is how you hold your business. If you hold it through a pass-through entity and you go back and amend the pass-through entity, you're likely going to have to go back and amend all of the owners of that pass-through entity's returns also. And the benefit that those owners would get would kind of depend on their individual situations too. So it's really just a bunch of different factors you need to consider. I think it does make a lot of sense to model a few different scenarios and figure out what the impact would be if you do go back and amend or if you catch it up in 2025, while factoring that you might be getting the refund sooner if you go back and amend instead of waiting until your 2025 return is filed.
Great, thank you, I appreciate that. We are running out of time, so I'm gonna bring us to the next slide. So again, just a recap of the provisions we talked about today. Look, the One Big Beautiful Bill Act, just like a lot of the other tax law that we've seen over the last decade, it's pretty voluminous. We did our best today to really call out the provisions that we thought would be most impactful for you. We did not cover everything. For example, there are international provisions out there that impact U.S. companies with cross-border transactions. And there's many other provisions as well. We thought these were the most impactful and worthwhile to talk about now. And again, this is evolving. So as any new tax law, we would expect quite a bit of changes to come out and new guidance to come out. So, we would encourage you all to keep in mind these are initial thoughts on these provisions, and we will certainly keep everybody updated as additional information comes out. It's a big opportunity. It's a big law, but it's a big opportunity. And thankfully, there is some time for some really good planning. Unlike the Tax Cuts and Jobs Act that was passed in December of 2017, thankfully, we've got a good half year to really work with you and help you with your planning on how this impacts you and what you can do to benefit the most. So we encourage you to keep an eye out on our newsletter. We encourage you to keep an eye out for any future webinars that we might do. Reach out to your contacts if you are a client with MMB. If you are not a client of MMB, we are absolutely happy to talk. Thank you all for participating in today's webinar, and thank you all for making today's webinar possible.
Thanks, everybody.